Are we still together? Who is against us? You know you're against
Yeah,
us.
we do, guy B. We do with you.
Ogake,
Yeah, with you, sir.
Okay. Oh. So, class, we'll talk about ingredients. There is no how you want to solve international investment without the mention of some ingredients in foreign currency, right? If we have understanding of these terms, it will really help when we start conversion. And that is why I need your attention, even if it is just 30 minutes, right? Because my system, I didn't charge it, right? So even if it's just 30 minutes, we'll do introduction, we go, right? Then on Wednesday, we'll continue from there. Excuse me. So we can't just talk about international investment, the advantages of investing overseas, this, which other things that we used to discuss in international advantages, disadvantages, all those things. There's no how we will talk about back to conversion. We will still need to convert. Class. So please, we need to understand some terms before we move to international investment. International investment is still your normal capital budget. The only difference is that the difference between the two is just when you get to the final place, you can now convert, right? Whether you are using direct quote or indirect quote. Okay. Now, foreign exchange currency risk and currency management. We need to understand exchange rates. What is exchange rates? Exchange rates is the rate at which a currency can be traded in exchange for another currency. That is what? That is exchange rates. What is the exchange rate? Rate euro to dollar or pounds, right? Where you can use something to exchange in one another currency is the exchange rate. It's called exchange rate. Another thing we need to know is spot rates, right? Is the rate at which currencies can be bought or sold for immediate delivery. If, for instance, you want to buy goods, maybe from Japan or from US, what is the current spot rate? Naira to dollar as of today, right? That is spot rate, right? It is called what? The spot rate, right? The Naira to dollar as of today for immediate delivery so that you can pay and get your goods. We can call it a spot rate. Excuse me. Then we have forward exchange rate. Forward exchange rate is also an hedging tool, right? But what is forward exchange rate? Rate is the exchange rate set for currency to be exchanged at the future date. Class, you can go to the bank, right? That is why bank will always they will continue to make profits. Forget all those ones where they declare till eternity. They don't see, they don't have foreign exchange loss. Where did they want to see it? Banks, they always want to make profits. Now, we'll get to that point. Forward exchange rates is the rate of currency at which you will exchange your currency at the future date. There is a formula for calculating when you want to determine the forward exchange rate. This forward exchange rate will be useful when you are embarking on a project for 4 years. This project is for 4 years. Oh, makes sense. And it is in dollars. You have to do what? You have to convert it to the currency, to Nigerian currency. And you are looking at this that the project is for 4 years future. So what will be the forward exchange rates? The rate at which you will convert that your cash flow in the future, class, is forward exchange rates. But we get there, right? Now, the need for foreign exchange. Why do people, businesses have to make use of foreign exchange? Because a company buying goods from another country might be required to pay in foreign currency. Class, when you want to buy goods in US, you will use the functional currency, the currency of your supplier to buy. You cannot use Naira to buy. That is the reason why you do what is it called? Foreign exchange. It is only in Nigeria, right, that when some foreigners want to buy goods, they have to use dollars. They have to pay in dollars. But when you go to their country, it is not possible. Right? So it's part of the needs. We'll get to the point where we will talk about, although our advice no they go anywhere, we'll just talk now. We'll just talk about it, right? We'll get there. Right. So that is the need for foreign exchange. We need it to carry out the transactions. Either you are buying goods or you are selling goods. And that is the need for foreign exchange. Foreign exchange. Now, we need to move further to talk about direct quotes. Class, you see, this is usually problematic in international investment. I don't just want to jump into international investment and start saying direct. I want to tell us how we get to that direct or indirect quote. You need to understand the terms in foreign currency. You need to understand the terms in international investment before we talk about international investment in full, right? And one of it is the direct quote, right? The question is, what is direct quote? If I will use this illustration, the spot rate as at today, for instance, for the purpose of this class, is 125 Naira to $1. You can see /$. It means that /$1. For those who are writing SBR, this will help you a lot in translation. Don't forget, under the translation, okay, we'll get there. 125 naira per dollar. Right? Now, when you see this spot rate, excuse me, when you see this spot rate, it means that it is a direct cut. Why? Because you, as a Nigerian company, your currency comes first. You see, can you see that your currency spot rate comes first? You're a Nigerian company, but your currency, you are talking about your company now, right? Want to buy goods outside, and you see a spot rate like this, and your company, the currency of your company is Nigeria, right? Is a Nigerian currency now. It's a Nigerian currency, right? And you have the spot rate to be 125 naira per dollar. This is a direct quote. When you see a local domestic currency, you will see it comes first. Can you see? You have 125 naira per $1. 125 for $1. That is a direct quote. What does that mean? When you are doing your translation, a subsidiary company in Ghana, then you are now translating it to the functional currency of a parent in Nigeria. You have to convert the Ghana cedis to Nigeria. Is that not so? And what are you going to use for your conversion? We should not equally forget there are different conversion. There is average, there is closing rate. Is that not so? Right? For those who are writing SBR, what are you going to use to translate what is in your income statement? Average. What will you use to translate your financial statement? Is the closing rate. Is that not so? Now, how are you going to translate it? Are you going to divide or multiply? That is another question you should ask yourself. And that will take us to direct quotes. If your company is a local, is a domestic maybe currency, or your company is situated in Nigeria, right? And they are talking about that company, and you see a spot rate to be 125 naira come first. The Nigerian currency comes first to dollar. That means it is a direct quote. Then let's talk about other currency. If it is not even Nigeria, let's say we have 1 euro, euro to dollar. You can see that euro comes first, and they said this company is located in Germany, right? This company is located in what? In Germany, and you have euro to dollar. And they are talking about this country, the company in what? In Germany. The euro that comes first, make it a direct quote. The same thing applicable if you are talking about a company in US. You have $1 to 1 euro. You can see that dollar comes first, and that country and that company is situated in US. It is a direct quote. Then multiply it with, in your conversion, multiply it with anything that they give to you, right? We will see how we will use it to multiply our terms, right? Now, Now, let's say we have 160 naira to $1, and it is a Nigerian company. They talk about Nigerian company, and you see the spot rate to be like this. It is a direct quote. And they said the Nigerian company will buy goods worth $10,000 in the US. Is that not so? In the US. Now, how do we now convert this $10,000 to Naira? You will just multiply. They say 170, 160 to $1. $1, 160. And that company is a Nigerian company. What are we going to do? You multiply 160 times 10,000, because the country of that company is what? Is a Nigerian company. And a Nigerian company wants to buy goods outside at what? At $10,000. Let's say they want to buy something worth $10,000. And the spot rate given to you in the question under the international investment is 160 naira to $1. And they are talking about a company that is situated in Nigeria, class. That means at the end, you are going to multiply this, your 160, times what they give to you. And that will give you the conversion in Naira. And that is a direct quote. The opposite of it is an indirect quote, of which we will get there. Class, am I communicating, please? Am I communicating? I need Toib.
Mr. Ibrahim, yeah, you are communicating, sir.
No, I not tell you, make it confirm. Okay. So you wear my energy drink.
You are busy to serve your visitor. I sent it earlier.
I beg. Oh, I should fire on. Energy don't go now. You say make a fire on. See this man. so see, these are the things we need to know. And that is why that is the reason why we are next gen. Because we do research work before we come to a class and say we want to teach. We are not teaching according to what is in the textbook, or we are teaching according to what is in reality that you can see. Even in your places of work, you may be working in an international company whereby you need to do a conversion. Then how will you do the conversion when you don't understand the direct and indirect quotes, right? Whether it is direct or indirect quotes, right? Like I mentioned, in SBR, when you want to translate your statement of financial position, you use the closing rate, which will be given to you in the question. In your income statement, you use the average rate given to you in the question. And when they now talk about the monetary and non-monetary, right? So it is what it is. So when you understand direct and indirect quotes, you can be able to convert. You can see that we multiply the dollars because it is a direct quote. The same thing applicable to your SBR. When you are doing your conversion, you can also apply the same thing, right? It will work out like that. So now, I just gave an instance here. You have Euro, maybe it's not Nigerian company, right? The first thing that you see here, and if the company is a German company, so you can say, oh, this is a direct quote. You need to multiply by anything given to you in the question, right? Take note of that. Now, the indirect quote is the opposite of what I just explained. The indirect quote is the what? The indirect quote is the opposite of what I just explained. Now, What is indirect quotes? Right? Let's forget about English. You have a spot rate to be, you have a spot rate to be $1 to 160 naira. What it means is that $1 is equals to 160 naira. And the company given to you in the question under the international investment is a Nigerian company, not a US company, a Nigerian company. Can you see the way they place the spot rate? The dollar comes first before the naira, right? And the company in quotes is a Nigeria company, right? That means it is an indirect quote because first, the company itself is a Nigerian company. One, and look at the spot rate. $1 to 160. Because we are using Nigerian company for the illustration, right? And this is what is an example of an indirect quote. The question is, what it means is $1 is equals to 160 naira. And you want to buy goods from the US and from a US company, and you want to convert to naira. Maybe the goods worth $10,000, right? Now the question is, how will you do the conversion? You divide. So therefore, it will be $1 divided by 160 naira times the goods. You can see you divide when it is indirect quotes. Can you see it? 1 naira divided by 160 times 10, meaning that the company we are talking about given to you in the question we are assuming that it is a Nigerian company, right? But if the company is US based, like US based, meaning that the naira sign will not even be there because it's US based, maybe dealing with US to Germany, China, and all that, right? Let's assume that the company is US based company, right? And you have $1 to 160. Oh, if the company in code they are talking about is situated in US, that is a direct quote because the company itself, the functional currency of that company is US now. It's not US. This is not also. So we are using, we just use a Nigerian company for instance, whereby they say, oh, the Nigerian company we buy goods outside, maybe $10,000, right? What you need to do is that you need to convert that $10,000 to the functional currency of that company. And you are given 1 naira to 160. So when you're given this spot rate, what you need to do is to convert, is to divide it, meaning that $1 divided by 160 times the $10,000, the goods you want to buy. So you are converting it to naira. The same thing applicable in your SBR, right? When you are given a spot rate like this, and you are given what is it called, the closing rate. What you need to do is that you can't just multiply, because look at the company. Where is it located? Is it a Nigerian company? Oh, if it is a Nigerian company, it is an indirect quote. Divide what they gave you, divide the spot rate, multiply it by the dollar given to you in the question. You convert it to naira, right? So that is what an indirect quote. Please, direct and indirect quote is as important as anything under the what? Under international investment. So before I proceed, do we have anyone that have question? If you have question, quickly unmute your mic. So before we continue, please. If you have question, you can unmute your mic. Who is against us? You know
Okay.
you're against us.
I'm not against us. I want to ask a question.
Okay, go ahead.
Okay, so is it possible we have more than two currency?
No,
Okay.
usually it's just two. You know, just like Nigeria too. Maybe you want to buy something now, so it depends on it. It we just the spot rate will usually be two. You get usually
Okay.
see two as the what as the spot rate.
All right. Thank you.
Yeah, you're welcome.
Hello, Mr. Ibrahim. Sorry. Hello, sir. Hello,
I'm,
sir.
I'm with you. I'm with you. I'm with you.
Okay, sir. Yeah, the only confusion I have here is to know which one, how to identify the
Ah,
local one. That's just
I've said this several times that look at the company. Where is the company situated? Is it a Nigerian company? That is when you will know that okay, this is forget the local or no local. Let's talk about the principle. You get? Let's talk about the principle. Check
yes, sir.
where the company is situated. What is the functional currency of that company? Oh, this company is US based. Okay. Then check the spot rate given to you. Okay. What is the spot rate? Do you see dollar comes first before the naira, or you see dollar? And you know, these are the things you need to check. What is the functional currency of that company first? Of course, they have to convert to their functional currency. Is that not so? For them to know that this investment will be viable or not. Do you understand? You
Yes, sir.
understand?
Yes,
So
sir.
I don't use all those local or no local currency to explain foreign currency because it's confusing, right? So just understand that what is the functional currency of this? Okay, is this okay? Now check the spot rate. Then use the spot rate to check. Or is it a direct or indirect code? Then you move from there, right?
The country you are talking about, is it the one that is dealing with the business or the one that
The
you are
company
buying?
itself, the company that they said AA Nigeria Limited is in US and they will buy goods in, they need to convert it to their, is in US, so they need to convert it to their functional currency. Is that not so?
Okay, yes, sir.
That is what I'm talking about.
Okay.
You get?
Okay. Yes, sir. Thank you, sir.
Yeah, you're welcome. Okay, we need to move, right? So now there's a note here, right? Usually I don't use it, but let's just move on. I don't need to talk about it. I will delete it, right? If I send the notes, I don't use it, right? Uh, okay, okay. Notes. I have a note here where the domestic currency, which is naira. Please pay attention. Oh, this is another thing you need to hold like this. If you want to solve question in international investment, what you need to know in international investment is how to determine forward rates, to know whether it is direct or indirect quote. 2, 3, to understand what is the functional currency of the company itself that you are dealing with. That's all. We already know our inflation, money, cash flow, real cash flow. Then we are done with international investment. Just understand that principle, right? So how to determine the forward rates? That will be another distance. So, but it's actually very simple, very simple. So, where the domestic currency is not part of the two currencies as given in the question, the currency with direct quotes, the currency with direct quotes should be treated as a domestic currency. We'll get to that point where we'll explain will explain it, right? But just hold this. In a given question, in the spot rate, there is no Nigeria. You see, look at it. Let's look at it here. Let's say you have, where is it? 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 Okay, let's say this. Let's say you have something like this. You have something like this, and the company they are talking about is a German company. And when you look at it this way, euro, you have dollar, right? Oh, comes first. Oh, direct quote. That euro itself, right, becomes the domestic currency, right? Because what the law says is that when you have two currencies as given in the question, the currency with direct quotes, and I assume that the company is based in Germany, right? Even if the sign is not correct, right? We'll assume it like that. So, right, you have €1 to what? $1. So with that, because the company is based in Germany, oh, you have €1 to, okay, this is a what? Is a so that's euro that comes first becomes, because it is a direct quote, that euro becomes what? A domestic currency. We'll talk more about this under the what? Under the forward exchange rate. But just take note of this part, right? So we have the bid offer. You can read this. Forward discounts or premium. Forward discounts or premium. Okay. Do we need this? Okay. Forward discounts or premium. Okay, we'll come back to this. Let's quickly talk about appreciation. Okay, let's talk about appreciation, currency appreciation. Yes. Appreciation or depreciation of currency. Class, how do we know if a particular currency is appreciating or depreciating? What is the sign? Currency appreciation occurs when the unit of the domestic currency to buy 1 unit of foreign currency decrease. Right? You can say the currency is appreciating. How do we determine if a foreign currency is appreciating or depreciating? Let's say we have $1 to 160 naira, or we have something like this, for instance, as a spot rate. Now, which of this currency is appreciating? Which one is appreciating? Is it dollar or naira? Gangang.
Please repeat your question, sir.
We want to determine the currency that is appreciating, right? Is it dollar or naira? Is that not so? And the law says that dollar is what? Appreciating.
Dollar is appreciating.
But can we really know without seeing movements in the? You just give us a static value now. Can we really know without seeing the movements?
Kenny. Let's say Nigeria now. Let's use our currency as a practical illustration. What is the naira to dollar? Naira to dollar as at today, maybe 150, maybe 1,500 or 1,600. Anyhow, maybe 1,500 to $1. So now check it. which of the two currency is appreciating? Reckon
Naira is appreciating.
That's Naira. Naira is appreciating now.
Dollar.
Dollar is appreciating.
Dollar is appreciating
Interesting.
Dollar.
because you need small
See,
dollars
Mr.
in order
Ibrahim.
to get
Mr.
the
Ibrahim.
naira.
Interesting.
Mr. Ibrahim.
I'm with you.
Let me please correct me if I'm wrong. You said that, let's say that a dollar is exchanged for 1,500 naira, Abi?
No.
Before.
Naira.
Is that not what you said?
Yes.
Naira is what?
Naira is what?
Naira is 1,005 and a dollar is
Yes.
to $1.
Yes.
But now it is $1 to 160 naira.
No, let's use practical. Let's forget about this $1 to $1 to
Okay.
160. Let's use the practical illustration. Nigeria, what is it called? Spot rate as at today. Can they? Are you still there?
I don't know today's rate actually.
Okay, let's assume. No, we are just assuming. Let's just assume that as of today is 1,500
Okay.
to $1.
Okay.
So which of the currency is appreciating? Is it dollar or naira?
It's naira now. It used to be above 1,500 before.
It's
Like
dollar.
1,000. It's
Kenny,
naira now.
Kenny, in as much that the naira is higher than the dollar, right? Naira is what? Naira is depreciating. It's higher than the dollar. Look at it here. The currency appreciation occurs when the unit of the domestic currency to buy one unit of foreign currency is actually what? Is actually decreased, right? So you can see that $1 is lower than 1,500, right? Don't look at it in that perspective that it used to be 1,007 or 2,000 naira. Now it is now 1,500. So naira is appreciating now. But no, look at it. Look at it in the perspective of, okay, compare it with what? With other currency. That is what we are talking about. Do you get? Are we sit together, please? Who is against us? Nigerian factor. so do we get that? So it is what it is. Okay, Kende.
Thank you. I think we are still saying the same thing. Like when it was, let's say, like 1,600.
Okay.
That means that if I want to send maybe like $100,000, so that means I will need more naira. I need to save more naira for me to be able to afford it. And now that the exchange rates has reduced to 1,500, that means I will now need I still need more naira, but not as much as I would need when it was 1,500. Is that
but it is not appreciating, but in your own side, you may look at it that naira, at least it's making sense. But when you compare it with other currency, right, you know that it's not even appreciating at all. Do you get?
Yes, sir. Thanks a lot.
Okay. Any other, make sense? Any other observation? Can we move? So the currency depreciation occur when the unit of domestic currency to buy one unit of foreign currency increases, right? 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 The currency depreciation, you can say, this particular currency is depreciating when you have $1 to 160. Imagine $1 to 160. 160 naira is higher than $1. is it not increasing? It's increased, right? You have one you have. Understand your point, Kenny, that here is the movement that from this place to this place it increased from this. You will see the movement when we start international world, when we start international investment, right? So please, you just need to understand what you need to understand. I mostly don't use whether it is appreciating or depreciating, but most times in international investments we make use of currency depreciation, because of course in the question it will be given to you that okay, the spot rate will depreciate by 5% or this, or you need to determine the percentage of depreciation as well, right? You want to embark on a project for 5 years, and the spot rate, the current spot rate is, let me say, 1,500. You need to determine the future rate. In determination of this future rate, you have to consider some inflation that could arise, right? That may actually affect the currency, right? Maybe the inflation, yes, the inflation, right? That may actually arise, that may actually what affect the currency and so on. So we need to factor in what inflation as well as depreciation as well, because when there is inflation and something may actually happen on the long run. So we look at all those things in full under under international investment. But you need to understand that you need to understand the definition of spot rate, the forward rate, the direct quote and indirect quote, and understand when currency is appreciating or depreciating, right? Whether depreciation or appreciation, right? So we have the market participants, we have hedgers, we have speculators. Those guys, they are market participants. They always, there are some guys, that is what they do. They speculate, you know, they hedge, they protect their investments, right? So most of them, you will speculators are guided by purely profit motive. They trade in foreign currency to benefit from the exchange rate fluctuation. There are some guys, we look at it, that I remember vividly when dollar was 2,000 naira, and someone said, go and buy dollar now, buy dollar keep so that you can so that you can sell. Now I think two weeks later, I'll be 3 weeks, dollar reduced to, I think, to about 1,005 or 1,006 there, about, because of the policy and all that. Imagine you buy at 2,000 and dollar fall to 1,600, so you make a loss, right? You make a loss. And I think the time permitters would have talk about what is it called, hush, under edging, netting, not netting. I will remember. There's one thing we also need to talk about if time actually permits us, right? So edgers, they protect their investments, right, against fluctuation of of commodities. So these are market participants, right? You can see them. Now, our focus, foreign exchange risk, right? Now, in the process, okay, foreign exchange risk class, in the process of exchange of goods and services, there is a risk involved. The examiner may ask you to explain the translation risk, the economic risk, the transaction risk, right? Maybe the big part of the question, right? So what are the foreign exchange risks? right? Foreign exchange risk concern the risk of an adverse movement in exchange rates over a given what credit period, right? The risk. And what are the risks? Number one, translation. Class, imagine a parent company in Nigeria and the subsidiary company in US. At the end of their financial year, they have to consolidate. Of course, they cannot represent the subsidiary, what is it called, currency in dollar when they want to consolidate. They have to consolidate based on the functional currency of the payment company. And what will happen if the foreign currency profit is 50 naira, for instance? Well, because in the process of translation, because of the exchange rate, what will happen to it? The profit may reduce because of the translation, may reduce because of the translation. So, translation risk affects the foreign exchange. Okay, sorry, please. So, that is what translation is. The risk is the risk that the organization will make what exchange loss, right? In what? In translation, right? Another risk we have here is the economic risk. Wow. Okay. I think we'll have to stop here. Okay. I think I have to explain all these things. Try. Okay. You're supposed to stop at purchasing power parity. Okay. Class, are we still together? Hello.
You,
Please,
sir.
are we still together, please?
Very well, sir.
Okay. That's fine. So now, economic risk. The question now is, what is economic risk? Right? Economic risk refers to the effects of exchange rate movements on the international competitive of a company's and present value of future cash flows. It is a degree to which the present value of a future cash flow is affected by adverse exchange rates because of the economy, class, because of the economy, because of, if you look at the Nigeria economy and look at it, others, right? And you can see that, economic risk will also affect the what? The foreign exchange, right? And what are the techniques if you want to hedge against this economic risk? I don't want to talk about hedging, but I'll just mention it, right? There is matching of asset and liability. That will take us to netting under hedging, right? We have diversifying the supplier. We have diversifying of nationwide, worldwide. You can diversify. When you look at it, that for you to do business in this country, so many factors, economic risk may actually affect the exchange rates. You can do what? You can diversify. Lastly, is transaction risk. Transaction risk, right? Most of us are faced with this transaction risks. For those who deal with, maybe who work in multinational companies. In fact, even in the multinational companies, they may have what is it called, hedgers or speculators, that they will look at it that if you look at what is it called, Cadbury, I think, is it last year that they declared loss? Yes, I think it's last year. It was last year. They declared loss. Then the question is, what could have been the reason why the company declared loss? We do the research, you check the company, and it may be that, let me don't use this is what happened. Let's say it may be that the company buy goods, raw materials on credit from a supplier in US. Imagine, you buy goods, you buy raw materials. When the spot rate is 1,600, then when you want to pay back, what happened to the exchange rate? Exchange rate becomes 2,500. For instance, what will happen to that transaction? You will pay more. The company will pay more. That is loss. In another case scenario, in another case scenario is to the customer, right? You sell, they sell, for instance, on credit when it was 1,500 or 1,200, and it becomes 2,000. They will make more money. So transaction risk is general, like it affects companies that usually buy goods on credit or raw materials on credit. Finally, before we go, right, we have an illustration. There's an illustration here before we go. A Nigerian company sells sugar. A Nigerian company sells sugar to a US buyer for this. Class, please listen. The exchange rate is this, but it is a Nigerian company. Class, is this a direct or indirect quote? Is it a direct quote?
Indirect
Indirect.
quote.
Thank you. Therefore, the Nigerian company expects to receive 15,000, because 150 times 100 we have this 50 million. The US buyer is allowed 3-month credits. We'll give you 3 months credit before you pay. But I think this is my goods. This is cash. The Nigerian company will just damn. They will receive. Oh, okay. I will explain it in our next class. Sorry. Okay. So on this note, I think we have to go. Thank you so much, everyone. Hello, are we still together? So please, yeah. So please go back to check the YouTube again. The introduction. There's no how we talk about the international investment without the mention of all these jargons. So if you understand all these jargons, you will see that international investment will be simple, right? Because you understand the basis, and these are the basis of international investment that you need to know before we move to international investment, right? So thank you so much, everyone, for joining. And visitor, right?
This is your visitor.
Yeah. So thank you so much, everyone, for joining, and have a wonderful evening. Thank you, and bye for now.